This is Kyrill Asatur with Centerfin Capital, and this is our collective weekly for the week ending October 4th, 2024. As always, we would like to highlight a handful of things that we think are important that happened this week. This week, we will discuss some new developments that potentially raise the risk of inflation down the line. So, not immediate inflationary risks, but longer term inflationary risks. And as everybody knows, inflation, the inflationary environment we've been living in for the last couple of years is very different than the one that we have experienced for many decades. Not since the 1970s have we experienced the kind of inflation that we're living in right now. And because of that, the rules of the road as it pertains to financial markets and obviously our daily lives have changed. And so we need to be on top of this and we need to understand how this potentially plays out. And this week, there were a number of things, as we said, that increase the risk of inflation down the line. The first, importantly, the escalation of the war in the Middle East between Israel and Iran's proxies, Hezbollah in Lebanon and Hamas in Gaza. This week, Israel they've been for a couple of weeks dismantling the organization of Hezbollah in Lebanon. And this week, they actually launched a ground invasion into Lebanon for the first time since this conflict started. The Iranian regime responded by shooting hundreds of rockets into Israel. And the effect of this on within financial markets has been seen in the price of oil. So the price of oil shot up. Brent is trading at around $78 a barrel, a price we have not seen in a while. It's still down from last year's levels, but the geopolitical tension that we've long discussed and geopolitical risk that we've long discussed has not been priced into things like the price of oil. And looks like this week it started to be priced into the oil markets. And why is that potentially inflationary? Pretty much everything we consume in this economy, goods and services, is somehow related to the price of oil, because the things you buy at the grocery store, they get delivered by trucks that run on oil. The trains run on oil that deliver those same goods and services. The ships run on oil. And if the price of oil stays elevated, that eventually trickles down to the price of goods and services. And so longer term, it's inflationary. And so it's something to keep in mind because we have not seen, the oil market has been relatively weak. And so that has helped with the inflation picture. If this geopolitical tension and the war escalates even further, we could see a continued spike in the price of oil, which would be, again, longer term inflationary for the price of goods and services. Second, we had a status check on the labor market. Today, the Labor Department released the jobs number for last month. The economy created a lot more jobs than expected. There were 250,000 jobs created versus 150,000 expected. The unemployment rate actually ticked down to 4.1% from a recent high of 4.3%. Now, this means that the labor market is strong and tight, which means that there could be potential wage pressure, meaning people can demand a higher pay for the jobs that they have. Now, we've seen an example of this very recently, actually this week, where the ILA, which is the union that runs all of that basically includes all of the workers that work at our ports that unload the goods that we get shipped from overseas, almost went, I think they actually officially went on strike as they were reaching a new agreement on a contract for the next 5 years. And what they were demanding was a 77% increase over 5 years. And I think they actually agreed upon overnight a 66% increase over 5 years. So that's 8% a year of increasing wages just for those workers. But that's indicative of the fact that the labor market is tight and hence wage pressure could persist. And that in itself is also inflationary because as you can imagine, if businesses need to pay workers more, that will filter down to the price of the ultimate goods and services that they provide. So that's another development we thought we should highlight because it does show you that the labor market is tighter than I think anybody expected it to be at this stage in the economic cycle. And last, we saw some new tariffs announced by the European Union against Chinese electric vehicle companies. Tariffs are also inflationary because they directly increase the price of goods. From the Trump administration was very aggressive with tariffs. Biden actually continued the tariffs that the Trump administration started. And depending on who gets elected in November, we could potentially see additional tariffs. Now, this will be, again, over long periods of time, this will be inflationary. And why is that all important? And why do we pay so much attention to this? Because inflation obviously has two main downstream effects. One is in the real world and people's lives, where the price of goods and services are higher. As we've spoken about before, today, the price of goods and services are about 25% higher than they were pre-COVID. And so your dollar has lost 25% of its purchasing power, or your dollar is worth 75 cents is another way to put it. That's obviously disproportionately negative for lower and middle income families, and that hurts them and their ability to live their day-to-day lives. And as it pertains to financial markets, as we've discussed, inflation is not necessarily bad for stocks, but it's really bad for fixed income assets. And for the last 40 or 50 years, as inflation has not been a problem, most portfolios have included some combination of stocks and bonds. And we have argued since as early as 2021 that fixed income may not be a good kind of ballast to the stock allocation in people's portfolios and institutions' portfolios anymore, just given the inflationary environment we're living in. And that continues to be the case today. And we think that needs to be factored in terms of how money is managed and how investments are managed over time, because the rules of the road of the past 40, 50 years do not apply in this kind of environment. And that's why we're very focused on it. It also highlights for you that there's a lot of uncertainty in the markets, and it doesn't matter until it does matter. And this week, a lot of things happened at the same time that really made us start to pay attention to inflation and be concerned about it. Again, longer term, probably not any immediate effect that you will see from this, but longer term, all these things could potentially be inflationary. That's all we had this week. We hope you have a nice weekend, and we'll see you next week.